Text overlay, welcome to Stag Research. Welcome back to Stag Research. I'm your host, Mr. Stag. If you're fascinated by founder legacies, billion-dollar infrastructure, and the businesses that power the modern economy from the shadows, you're in the right place. Today's story is about a company you may have never heard of, but its properties touch nearly every product you use. This is the story of STAG Industrial, a behind-the-scenes titan that has quietly built a logistics empire by betting big on America's industrial backbone. STAG Industrial was founded in 2010, but its story really begins with Ben Butcher, a veteran in real estate investing. STAG Industrial was founded by Ben Butcher, a name you likely haven't heard but should know. Ben wasn't your typical flashy Wall Street guy. The son of a real estate executive, Butcher had industrial real estate in his blood. After graduating from Bowdoin College, he earned an MBA from the Tuck School at Dartmouth and spent years building experience in acquisitions and real estate finance. His early career was spent inside REITs and private equity-backed real estate firms. Over time, he noticed a recurring pattern. Large players focused on trophy assets in Tier 1 cities, think New York, Chicago, or LA, while secondary and tertiary markets were being overlooked. Butcher saw opportunity in those ignored cities, Buffalo, Louisville, Des Moines, where single-tenant industrial real estate quietly powered logistics, manufacturing, and regional supply chains. So he made a contrarian bet that institutional capital would one day recognize the risk-adjusted value of these boring assets. That's the origin of STAG, which stands for Single-Tenant Acquisition Group. Butcher's leadership style was methodical, disciplined, and focused on cash flow over hype. He valued long-term relationships and consistently executed on a vision that many others dismissed as too niche, and it worked. While many REITs focused on glamorous office buildings or booming apartment complexes, few targeted single-tenant industrial buildings, the unglamorous warehouses and distribution centers that logistics giants depend on. That niche, ignored by many, became STAG's golden opportunity. STAG was structured as a real estate investment trust, or REIT, from the start, allowing it to return most of its earnings as dividends to shareholders while avoiding corporate income tax. It began acquiring properties from companies looking to lease back their facilities, allowing them to free up capital without relocating their operations. In April 2011, STAG Industrial went public, pricing its IPO at $13 per share. At the time, it owned around 90 properties with a total enterprise value of just under $450 million. It was a small REIT, and Wall Street was unsure what to make of it. Could a company built on sleepy warehouses in flyover states really scale? For the first year, STAG's stock performance was flat, but under the hood, the fundamentals were strong. The company executed steady acquisitions, avoided overpaying, and maintained high occupancy. More importantly, it introduced a monthly dividend, an investor-friendly move that set it apart from its quarterly peers. By 2015, institutional investors began to take notice. STAG doubled its portfolio, attracted REIT-focused ETFs, and proved its model could scale. The typical industrial REIT focuses on high-end logistics campuses with multiple tenants. STAG flipped that model. Instead, it built its business around single-tenant properties, often in secondary or tertiary markets, places like Tulsa, Oklahoma, or Spartanburg, South Carolina. Why? These properties often trade at a discount, offer better cap rates, and face less competition from institutional buyers. STAG isn't chasing prestige, it's chasing yield. Another unique element is its risk-adjusted investment model. STAG evaluates each acquisition with a proprietary risk score that balances tenant quality, lease length, geography, and building specs. This system allows them to scale without exposing the portfolio to too much downside from any one tenant or region. Today, STAG owns over 560 properties, totaling 111 million square feet across 41 states. Ben Butcher isn't a household name, but he's been instrumental in building STAG's disciplined culture. He believed in the boring is beautiful philosophy, focusing on predictable income streams, long-term leases, and underserved geographies. Under his leadership as CEO until 2021, STAG grew from a modest startup to a $7+ billion REIT with a consistent track record of dividend growth. Even after stepping down as CEO, Butcher remains involved in strategic planning and remains a respected voice in the REIT community. Stag's timing couldn't have been better. As e-commerce exploded, demand for warehouse space surged. Amazon, FedEx, UPS, and honestly, dozens of third-party logistics firms needed places to store and move inventory. Even mid-size companies needed regional distribution centers to shorten delivery times. From 2010 to 2020, Stag grew its portfolio nearly tenfold, benefiting from this secular shift. Its average lease term is around 5 years, but, many tenants renew thanks to the cost and complexity of relocating industrial operations. During the COVID-19 pandemic, industrial real estate became one of the most resilient sectors, as consumer spending shifted online and supply chain resilience became a priority. Stag thrived, reporting record occupancy and strong cash flows. Stag's revenue model is simple. It collects rent from its tenants, many of whom are in essential sectors like manufacturing, transportation, and e-commerce. The company's market cap is roughly $6.7 billion, with a dividend yield of about 4.2% as of 2024. Its occupancy rate sits around 98%. Top tenants include Amazon, FedEx, DHL, GE Appliances, and others. Annual revenue comes in at about $700 million, and FFO, funds from operations, which is Stag's preferred profitability metric, tops $400 million each year. Payout frequency monthly. Debt to equity ratio 0.6. Geographic focus 40+ states, with presence in markets like Indianapolis, Memphis, Jacksonville, and Salt Lake City. Because it's a REIT, Stag must distribute 90% of its taxable income to shareholders in the form of dividends, making it a favorite among income investors. It also maintains a conservative debt profile, keeping leverage below 35%, which gives it resilience in high-rate environments. Stag competes with other industrial REITs like Prologis, Duke Realty, and Rexford Industrial, but it occupies a unique lane. Prologis dominates the global logistics hubs like Los Angeles, Chicago, and New York City. Stag operates in the long tail of real estate, smaller cities where competition is lower and yields are higher. Its edge is in underwriting discipline, scale in smaller markets, and deep relationships with local brokers and tenants. While Prologis focuses on global scale, Stag wins by being everywhere else. And as e-commerce expands beyond major metros, Stag's presence in regional logistics is only becoming more valuable. No REIT is risk-free. Stag is exposed to tenant concentration. Amazon and FedEx occupy significant portions of its square footage. Geographic risk. Secondary markets can face slower economic recovery. Interest rate pressure. As a yield play, rising interest rates can compress REIT valuations. Lease rollover. While most tenants renew, economic shocks could drive vacancy in weaker regions. Still, Stag's risk model, high occupancy, and diversification across hundreds of assets mitigate many of these concerns. In 2023, Bill Crooker took over as CEO, continuing the company's conservative but opportunistic strategy. Stag has also begun exploring ways to incorporate smart logistics, including warehouses with robotics, AI-powered space management, and solar panel retrofits. With the rise of reshoring, American manufacturing is making a comeback, and Stag is well positioned to supply the infrastructure it needs. Analysts predict steady dividend growth and strong total returns, especially as automation and AI make logistics even more central to the economy. Stag Industrial might not be a household name, but that's exactly the point. In a world obsessed with shiny tech, Stag has quietly built a $7 billion empire on steel roofs, loading docks, and last-mile delivery lanes. It's the hidden engine behind the products we use every day. So what do you think? Is Stag a smart bet on the future of logistics, or a niche that could be outpaced by larger players? Let us know in the comments. Don't forget to like, subscribe, and share this video with anyone interested in real estate, dividends, and hidden business empires. Mr. Stag, logging off.